Alberta and how you can still make money in Alberta and what the challenges are. We are waiting for a number of people to join us still, so I will just start very slowly. So if you don't know me, you can also get used to my accent. And then I will speed up as we go through the next few slides. So it's a fast-packed agenda. What we want to cover over the next hour or so is what investors are looking for today, what we're hearing from our investors, how selected real estate can play a role within that, specifically apartment buildings or residential rental income properties. Is the party over, or is there still buying opportunities? We'll cover that. Then also, who are we in the end, and what is the investment vehicle if you choose to part with some of your money and invest it with us. So I'm trying to operate the screen controls here, see whether that is working or not. So what we hear from investors who we talk to, and we today have over 700 investors in our various funds. Usually people want stability. They're sick and tired of the stock market volatility. They usually want some predictability, i.e. not 20% one year and then -2 the next year and then +12 next year and then maybe +2 and then -8. Something more predictable. Many investors, especially older ones, want income, although the younger folks usually forego that for equity upside because they're of the taxation issues. They usually work. You know, if you can produce income, you also have to pay taxes on it. And usually they want some diversification outside the stock market because many folks have their RSPs in stocks or mutual funds, and they want something else. So if that's what you want, then you're in the right party tonight. So let's look at some stocks here, and that's where a lot of the money is part of investors we talk to. So this chart shows you a 14-year chart of the Toronto Stock Exchange, TSX, over the last 14, 15 years, starting at about 8,000 to today roughly around 14,000. So if you had invested 14 years ago, you would have made about 3 to 3.5% a year, which is okay. You know, it's not wow, but it's certainly not terrible. So again, if you're a stock guy, that's what you should expect if you buy raw stocks or perhaps an index like XIU, which is a TSX tracking ETF. Now, some of you have money parked with mutual fund companies, which usually take about a 1 or 2% fee per year. So if I take off about a 1.5% here, you would have made about 1 to 2% per year had you invested and stayed in the market for the last 14 years. So not so sexy all of a sudden anymore. Now let's look perhaps at 7 years. Maybe you went to the market just before the crash in late 08, early 09, but maybe you invested in 06 or 07, sort of around 13,000 or so. You would be up today, probably about 0.5% to 1.5%. If you had bought stocks. If you had actually bought a mutual fund now, you would be probably negative. Like many of our investors who come to us realize that after 7, 8, 10, sometimes 14 years, their RSP isn't going anywhere. So that's all the reality we see today in the investing world. So the idea of getting 8% a year with stocks is certainly not doable anymore unless you're a very good stock picker. And maybe some of the folks in the line are that. What about bonds? So you can lend money to the Canadian government or the US government. And as you can see, the bond yield over the last, again, 10 years has been declining. Today, it's actually sub 1%. If you give money to the Canadian government for 5 years, it's still sub 1%. If you give it to them for 10 years, it's about 1.5%. If you give it to the US government, very, very similar. If you give them 30-year money, i.e. you give the US government money for 30 years, and buy U.S. Treasury bonds, they were trading at about 2.3% for 30 years. So that tells me that interest rates will not go up the next decade or two, perhaps. And there's a blog I put on our website about a week ago. So let's talk about some asset allocation. Keep in mind that I am not a licensed advisor, nor is Mike, who will come on stream here in a few minutes to talk about the buildings we own and the performance of the buildings we've achieved over the last few years. So keep in mind that these are just opinions of the author or the presenters, and we cannot give you financial advice. So to do that, you have to hire a financial advisor. This is what I do. I allocate my money roughly in three buckets. One is roughly 60% low risk, perhaps a bit higher today even. Maybe a third, 30% or so is medium risk, and 10% is speculative high risk stuff. So the question is, what is high risk? If you do land development with mortgages, to me that's high risk. If you lend money in second position as a second mortgage in a construction project, to me that's high risk. Penny stocks. Many construction projects with mortgages, to me, are high risk. If you lend money to the Greek government, to me that's high risk, because the question is, will you get your money back? If you invest in software firms or restaurants, which I've been doing, I had some hit and miss there because I'm from a software trade. I did some good runs there, but also extremely high risk. So you got to really be mindful of, if you put money in with in these buckets, that the chance of substantial loss or perhaps total loss is real. What about medium risk? Well, if you buy land, which we have in Coal Lake, we'll talk about that briefly today, but with no mortgages or interest-bearing mortgages, that to me is medium risk, certainly higher risk than some of the stuff we talk in a minute. If you lend money in second position, but not on construction projects, let's say on an existing commercial building or perhaps an existing single-family house or an existing apartment buildings, depending on loan to value and the location of that building, in my case, it's also, in my opinion, it's also medium risk. Also, most stocks are medium risk, in my opinion. If you lend money to a European government, Eurobonds also medium risk. The question is, how long will the euro survive? Gold, diamonds as well, in my opinion, tied to the US dollar. As a Canadian, not necessarily a good investment because gold usually goes inverse to the US dollar. The US dollar will likely strengthen over the next few years, so gold might actually go down in US dollars. Commercial real estate, certainly you can make a lot of money if you know the asset class well and manage it well. But certainly the risk is higher, and therefore the cap rates or the yields you need to get from these office buildings or retail centers or industrial buildings needs to be higher than an apartment building because the risk is higher, the vacancies are higher. Or if you do construction projects, even with low mortgages, in my opinion, they are high risk. Well, what's low risk, in my opinion? I would say apartment buildings with modest mortgages. Modest to me is maybe up to 70, 75%. If you lend money as a first mortgage provider, which you can do through your RSP, that also, in my opinion, is low risk. Depending, again, it's up to the loan to value. And if you buy quality corporate bonds or many municipal or government bonds in Canada, fairly low risk, but again, you get currently maybe 1 or 2% of government bonds. You might get 3, maybe 4% in quality corporate bonds, although even those are lower. I think Apple came out with a bond in the 2% range, and it was snapped up in a few minutes, like a few $1 billion. So even if you lend money to big companies like Apple, you don't get much of an interest rate. Keep in mind again that the Security Commission, which regulates the investment in Canada, would call all these investments risky, because what we do is we syndicate projects, and it doesn't matter to them whether it's a commercial project or an apartment building in Calgary with no mortgage, or land in Guatemala or in Libya. It's all risky. So therefore, the document you might have to sign say everything is risky, although we understand that certainly certain asset classes are less risky than others. But keep in mind that under the security rules, everything is risky. offered through the exempt market in the private equity space. Okay, what are some other rules you need to follow? Well, here's our friend Warren Buffett. He had 3 rules. Number 1 is never lose money. Number 2 was don't forget lesson number 1. I think the 3rd rule was marry rich. So that certainly helps. But here's sort of Thomas Byers' millionaire rule superimposed to Warren Buffett's rule, which is if you never lose money and make 6, maybe 8% consistently over the years per year, especially with money you borrow perhaps at 3%, such as an apartment building, you will beat 95% of all investors and become a multimillionaire. So the trick is really to find a consistent asset to invest in, which you can lever sensibly with cheap money, and you will come out ahead. And yes, we will not do 20% a year. It's not doable in our asset class, as you can do in some penny stocks or oil stocks perhaps right now, as they're beaten up. But it's also not as volatile, and you can consistently make 6-8%. And happy to report that so far none of our investors have lost money with us. And therefore, if you look at the apartment building space over the last 30 years, which shows an average price here, average index, if you had bought $10,000 worth of an apartment building in Ontario or in BC or in Alberta, you don't see these wobbles I showed you earlier of prices going up and down. What you see is fairly steady growth over the years, even through all these crises in 97 and in 87 and in 2001 internet bubble, and then certainly 08, 09, where we had major crises and stock markets dropped 50%. We had essentially maybe a flattish market, but not even a dropping market. Okay, so why do we like residential communities, and why should you too? That's the picture of me, in case you haven't seen me. And we'll have some other pictures of Mike later in a few minutes. It's one of the safest asset classes because regardless of what's happening in the economy, people have to live somewhere. So as a segue into Alberta right now, so Alberta, certainly there is more uncertainty. House prices are starting to soften. We see more sales, we see more listings. People are getting more worried about their jobs. Some have lost their jobs already. And guess what? In that environment, you will not necessarily buy a house, but certainly if you have just moved there perhaps, or you are thinking of moving, you will rent. So we foresee at the moment that there will be very little impact on rental properties. I show you some charts here of buildings we have owned for a number of years. So this is a building we've owned for over 10 years now, since 2004, called Windsor Estates on the west side of Edmonton, near the West Edmonton Mall, about 5 blocks from the mall, 178th Ave and about 178th Street and about 95th Ave. The building we bought had a rent roll of about $55,000-$60,000 when we bought it, and today the rent roll is about $115,000 a month. And you see steady growth over the years, but I want to point out specifically the timeline, sort of 08, 09, 2010, late 07, when the market really went sideways and down due to the financial crisis. And what we've seen there is that the market went up a little bit still, actually, but it was mainly flat. And what on the bottom line, you see our net operating income sort of goes up and down a bit in the winter and the summer, but also has been rising substantially over the last 10 years. But the point I want to make is that in a recession, and Alberta may have a recession in the next 2-3 quarters, we expect the rent roll to stay fairly flat. We don't expect major increases, but we also do not expect major downside to rents. Here's another building we have owned in Stony Plain for over 5 years now. Similar increase over the last few years, from about $35,000 to maybe $55,000 a month. A substantial 50% more increase in about 4 years. This is the building in Calgary. Similar rent went up from about the 80,000 mark to about 115,000 in about 4 years, up about 40%. And the last building I want to show you is the building in Dallas we own for about 7.5 years now. And again, in the 08-09 time frame, the market went flat and has been rising and has been up about almost 50% the last 7 years, so about 6-7% a year. So really what's happening is that if you own a building, rents go up and down a bit and wobble, expenses take a while to stabilize. So usually in the first 2-3 years, we invest heavily in the asset to stabilize the cash flows and the expenses. And then after sort of year 3, it becomes more stable, more predictable. The good news, though, is also that we usually have a mortgage. And whether the times are good or bad or indifferent, we usually pay our mortgages down. So as an example, this is a building where I paid $3 million in cash, got a $7.5 million mortgage, and in 5 years, I paid the mortgage down by about $1 million. So I divide the $1 million of my debt reduction in 5 years over my initial investment of $3 million in this $10.5 million asset. I get a 34% return in 5 years, or 6.8% a year, just on mortgage paydown. I don't count the cash flow, which often gets reinvested in the building, and I do not even count any upside, which I usually get if I reinvest money in buildings. So just by sitting on your assets, you can make a lot of money in the 5, 6, 7% range. And it gets even better. And that's why we recommend to people to stay more than 5 years, because in year 6 to 10, you pay a mortgage on even faster, almost 45% on that $3 million, about $1.3, $1.4 million. You make almost 9% a year just on mortgage paydown, assuming you don't refinance, which we often do to pull cash out, either to send back to investors or to maybe buy additional assets. So there's a good case here to be made that even in the flat market, you can get some solid single-digit returns without that fluctuation in the stock market. And then, of course, there's upside, and I'll talk about that in a minute as well, because obviously we tend to reinvest money into the building. So let's look at a typical example here. I have a building, let's say, which produces a net operating income of about $100,000 a year, and they're using a 5% cap rate, which is the multiplier I use, or the yield. That building would cost about $2 million, let's say in a market like Calgary or in a good location in Edmonton. I would pay a 5 cap. So to get $100,000 of income, I need to pay $2 million for that property. Let's assume the rents go up 20%, not in 1 year, but perhaps in 3 or 4 years, or in our case, sometimes in 2 years. So the property goes up also 20%. Now it's worth $2.4 million. So I get a $400,000 property value increase, which is a 20% appreciation, assuming you pay cash for this asset, which you usually do not, because usually you get a mortgage. The most common mortgage we get these days is about 25% down, 75% mortgage, in the 3 to sub 3% range if it's with CMHC. So let's say I bought this building for $2 million. I put down 25% or $500,000. My property went up $400,000. Now that's now an 80% increase, cash on cash. That's not counting the mortgage pay down I showed you earlier. It's not counting cash flow. I assume for now the cash flow was reinvested into the asset to get those rents up. What I also don't show, of course, is that there is cost involved. Opening our limited partnerships and raising money is not cheap. We have fundraising costs in the 12 to 16% range. So once the money is in the bank, I cannot deploy all the money because there's costs involved, commissions, legal fees, audit costs, security filings. There's also often investments in the asset, and of course we take a fee as well. We want to make some money, obviously. So these are theoretical figures, assuming you do it all yourself. You buy the building yourself. You don't pay yourself a wage. You don't pay any fees for yourself. So in the real world, in our limited partnerships, the returns wouldn't be quite as high because we take a share of the profits, and there's fees involved and upstart cost. But it does to illustrate a point. So the idea is, again, you buy well below replacement cost, because to buy a building today would cost you well over $200,000 a unit usually, and we buy buildings today in the $125,000 to $150,000 range, depending on where it is and what the quality of the asset is. And Mike will come on here in a few minutes to talk about some of those specific numbers. So we buy the building, we then add value, the building goes up in value, and as long as it stays below replacement cost, which is a brand new building, we are fine. The business model still works. And that's the case today. So we have cash flow, we have potential for upside, and we have low risk compared to, let's say, buying an office building or buying a retail center or an industrial warehouse. Okay, let's talk about Alberta a bit, because obviously you came on the call here to listen about Alberta, and you know, is Alberta disappearing from the face of the planet because no one buys oil anymore, allegedly. So here's some numbers to contemplate, because we take the long view, and long to us means at least 5 years, sometimes 10 years. We don't necessarily look out 2 or 3 quarters only, because we invest and buy a building and need to take a view of what will this building look like in 5 years or in 7 years or in 10 years, you know. The various studies out there, this is one by BP, which says that over the next 2 decades, the world energy consumption, despite all the energy savings and more fuel-efficient cars and more building installations, will still increase by 37% for the next 2 decades. And energy, while not all oil, obviously, and gas, to a large extent is oil and gas, because solar or wind cannot produce energy at competitive price points. And it's tough to fly to Europe or to vacation in Hawaii in a solar airplane, especially if it's more than one person. So oil will be with us for a long, long time. Canada is at the moment the 3rd largest oil reserves in the world, has the 3rd world's largest oil reserves. Proved oil reserves are about 150 billion barrels. There is more oil below that, and they use a different term for that. It's probably over $1 trillion barrels of oil in Canada, but proven and measured, and are these numbers. So Venezuela and Saudi Arabia are quite large. Venezuela also has oil sands and tar sands, like thick molasses-like oil, also very expensive to produce. Saudi Arabia, as you know, has the light oil, and they can just turn a tap on and off and squeeze all the other guys, like they do with Iran right now, right? Because Iran is building a nuclear bomb potentially, and they don't like that. And they want to keep the upper hand in the Muslim world, and Sunni and Shiite Muslims fighting it out right now between these 2 large groups in the Middle East. So that's another backdrop of the political play. In addition, Canada is also the 5th largest oil producer in the world. China, Iran is up there, similar to Canada, in the number 5 or 6 position, with about 4 to 4.5 million barrels a day. The bigger ones are Russia, Saudi Arabia, and the U.S. U.S. is almost the world's largest supplier now, close up there with Saudi Arabia and Russia, between 9 and 10 million barrels a day. So per capita, Canada is a very large oil producer, because compared to the U.S., for example, which produces, you know, over twice as much oil as we do, they have 10 times the population, for example. Iran also much, much bigger population. China certainly as well. But in addition, we also have uranium. We are the 2nd largest in uranium reserves, large producer, mainly in Saskatchewan. Lots of hydroelectricity, huge crude reserves, I mentioned that, lots of gas production. So there's other stuff, and there's coal, and there is diamonds, and there's potash, and there's nickel, for example, in Sudbury we own a building. So there's lots of other resources Canada has, which the world wants. This is an interesting chart, and maybe of all the charts perhaps in this presentation, I find this is the most interesting. It shows you the world, or the Alberta view of the world in about 25 years. It's expected that Alberta will grow by about 50% from currently around 4 million people to about 6.2, 6.3 million people, and that both Calgary and Edmonton will double in size from currently around 1.2 to over 2 million people. And then all the other cities, like you see there, Red Deer, for example, over 300,000 people, or Cold Lake area where we have a project will grow substantially, or Whiteminster, many other markets will grow. And where the market is growing, you need rental properties and all sorts of other commercial real estate. So if you take the long view, not necessarily 25 years perhaps, but maybe 5 years or 10 years, the world is pretty rosy from an Alberta point of view, because we will have more and more people moving there, as opposed to perhaps Europe or Germany or even Japan, which have declining populations. So you want to invest where there is growing populations, such as Alberta. There is some statistics and forecasts that Alberta and especially Calgary and Edmonton will lead in job growth. Not this year. We expect a mild recession, so we expect some job shedding. We expect some modest decline in house prices, which should actually benefit us as landlords to receive more renters, because if you don't know if the house you're buying for $400,000 might be worth $380 next year, you might not buy that house today. You might rent for another year or two. So if you look at some projected job figures here between now and 2020, these numbers are all up substantially. And people have jobs, they will either buy something or rent something. Usually immigrants, roughly half of them rent and half of them buy. And then after 2 years, they realize either go back, or even if they're longer, they might rent some longer. So the rental outlook looks fairly rosy for Alberta. Again, this year we expect a softening in the house price market. Probably we expect flat rents, no concessions, vacancies are still very low. Oil sands, certainly a large producer of jobs. This chart was done, I think, about a year ago, so the numbers might be a little bit lower going forward, but this shows the number of jobs in oil sands today, about 300,000, expected to roughly double in about 7-8 years. That might not be quite as steep, in my opinion, going forward with oil at 60 or 70 bucks a barrel. We're going to continue to see oil sands projects going ahead. We're going to see drilling, but not quite at the pace perhaps we had envisioned, a year or 2 years ago. Nevertheless, we still expect that oil sands jobs will go up over the next few years. So this has 90% more jobs in 7 years. Let's cut that down by half perhaps. So it's still a 30-40% increase in number of jobs. Suncor is still pushing ahead with a number of projects. They don't cut off all the projects, and what you see are the headlines, right? Suncor chops the budget by $3 billion. That's a huge number, but they're still investing $6 or $7 billion. So it might go from $10 billion to $6 or $7 billion. That's still a huge number. So what the headlines are in the news, you see the focus on the cut as opposed to the project is still going ahead. So this is many of these oil sands projects are profitable, especially with lower labor costs now at over 50 bucks a barrel, and that's where we are today. And while we might drop a bit lower, maybe to 30 or 40 bucks, we may have seen the worst just in December, basically early January, when prices were, sort of sub 50. Now we're in the high 50s and low 60s, so we'll see where that goes. Certainly there is layoffs in Alberta and more uncertainty, so people, instead of buying a new Lexus, they might wait a year and keep their old Beamer for another year or two. But we don't, because we're not in the Lexus business nor the condo sales business. We're in the rental business primarily. We will ride out the storm, in my opinion. Still a lot of projects on the go, $86 billion, which are currently in production or near completion, and plus another $200 billion of projects on the drawing board. Now again, that number will be reduced, or those projects will be moved to the right. But still a lot of infrastructure projects, pipeline projects, transmission projects. Joffrey, for example, which is near Red Deer, near the mobile home park we just acquired, they announced they're going to add a few hundred jobs for the petrochemical division, because petrochemicals get sold, for fluids, for example, whether the oil is up or down, and they make money on the margin. They don't really care what the oil price is. They buy oil at $50 a barrel and sell their stuff for $500 a barrel, which is upgraded, enhanced kind of oil, perhaps for motorcycles. So to them, the price of oil is really immaterial. So a lot of petrochemical, for example, in the Red Deer region, where we own 3 properties. And even OPEC is bleeding, and Bahrain, which I visited last year, and Iran and Iraq, they're all crying. Lots of whining, I would think, at the Arab dinner tables these days. And here's what, for example, OPEC's Secretary General says, that he says we've seen already price at the bottom, which was sort of just sub $50, and the world needs several $100 billion of investments every year for new oil projects to come on stream. And if you cut that off too much, you will have a shortage perhaps. Now again, we will not see that this year. We might not see it even in 2016, but we might see shortages in 2017 if the reduction in oil production growth continues. So if we have that underinvestment, we will have a shortage eventually. So that is, we will see. No one really knows what the price will be. Expectations are there will be sort of around $60 to $70 a barrel in the next 2 or 3 years. RBC suggesting that Alberta will return to healthy growth in the third quarter. The media will certainly harp on recession. You're going to see the big R word the next few months in the media. As soon as we have negative growth of 0.1%, it's going to be major doom and gloom in the media, recession talk. Although there's a 0.1% or maybe 0.5% drop in the GDP, and it's going to pick up again later this year, most likely. So therefore, if Alberta is to return to healthy growth later this year, then of course the time to buy now is to buy some cheaper real estate is now, in our opinion. As an example, and Mike can elaborate on that, we wrote an offer on a building last fall, a large building on the south side of Edmonton, a nice building, and we offered in the high 150s a door which was really expensive to us. We thought this is really, really expensive. They came back to us and said, well, why don't you sharpen your pencil? We offered in the low 160s and told us it's really insane. The price is really too high. We didn't get the building because we got outbid by another firm which bought this building plus a few others. But they found some environmental issues with the other buildings, and the entire package of buildings now collapsed. The sale is collapsed, and now the building is up for sale again, and we are now writing an offer as we speak. Mike and I are talking tomorrow about what price we should put down. It's going to be probably somewhat lower actually than what we were envisioning to pay in the fall. 5-6 months ago. So prices are softening a little bit because prices were really unrealistically high last year. People used forward-looking expenses and forward-looking rent ratios, and then used very aggressive cap rates. And we're going to see a lot more normal numbers and maybe also more motivated sellers, price point wise. Vacancies will still be low, so we don't see. I think we'll not see a super high motivated seller crowd because you can borrow money at low rates today. But the trend is your friend, and what I show you here is a 15-year chart of an average apartment building in Edmonton. From the low 20s in 95, I started buying in the year 2000, sort of in the high 30s a door, and prices have developed steadily, where today and you see in 07, the price overshot a bit. We sold a lot of buildings in 07 into the boom. And the market is more or less, I think, where it ought to be right now, in the 120s a door for an average building. And you get a one with lots of 2 bedrooms, a nice location, you pay, of course, more than that. And we might see a bit of a flat line here for a year or two, but then we'll probably see prices rise again. So one way is to position yourself today for the future, because we had this boom in 07, 08. Prices were at 117, or 115 a unit, and they dropped a bit. Lots of jobs were cut. Prices reduced, came down a little bit, and now 5-6 years later, that same building would be 125 a unit. We didn't buy anything in Edmonton for about 3 years between 07 and 2010. We started buying in 2010 again. And we're going to probably see a bit of a breather here in the next year or two as well. But the question then is, here's where we are today. Where will we be in 5 or 7 years when we have, more trades again and more jobs and more immigrants? I expect the price to be, in the high 160s, 170s perhaps, compared to maybe 125, 130 today. So maybe 25, 30% higher. Okay, let me maybe pass the mic here to Mike. Again, who are we? And then I'll pass it to Mike. So I'm the fellow on the top left, Thomas Bayer. The fellow below me is Scotty Grubb, who is our chief fundraiser, currently actually in Calgary, talking to some investors, who was instrumental in helping us raise over $45 million, and we deploy that in Canadian and cities, mainly in one city in the U.S. Our asset base today is slightly over $100 million. We have delivered double-digit ROIs to investors, not necessarily per year, but certainly overall. And we also have our in-house property management firm, Fireside, which is run by Keith McMullen on the bottom left. He's in Calgary, as is the young fellow there above Keith, which is Mike. Mike is also in Calgary, father of two and 3/4, I should say, because there's a baby coming in April. So with that, I think I'll pass it to Mike, who will talk a bit about the assets we own today and what we do with the assets and how we create value, and then I'll come back at the end for maybe 10 more minutes. Mike, you want to take it from here?
You bet. Thanks, Thomas. It was a great overview. I know there's lots of questions out there with regard to the economic state in Alberta, and I think we still see some long-term opportunity in the province, and we're quite excited about the opportunities on the acquisition side over the next 12 to 24 months, and hopefully see some less competition on the buy side. So, there is some opportunities there, and we hope to take advantage of them. Before I go on, I just want to remind people or just indicate to people that we are going to do a Q&A at the end of the presentation. So if you take a look at the control panel on your screen, there's a section in there for questions. As we go through the presentation, we encourage you to go in and type out your questions, and at the end of the presentation, we'll make sure that we have every question answered before we wrap up. So again, as we go through, if anything comes to your mind, whether it's about the existing buildings that we own in our funds, about what we do, or about the current opportunities, we'd love to answer your questions. This is the assets under management across the Prestigious Properties group of companies. So this is a snapshot today of our entire portfolio. So this is including all of our current limited partnerships outstanding, so previous investments that were closed for investment today. But this gives you a snapshot of the geographic location, the types of building sizes that we would buy. It shows you our purchase price as well as the current values of our apartment buildings, our land properties, land holdings in the middle section, and at the bottom is also our cash. So that's where we're obviously looking for current opportunities. So as Thomas mentioned, our total assets under management today is just over $100 million. This is taking a look back since the company was founded in the year 2000. This is looking back at the track record of all of the properties that we've bought and sold in that time frame. So it shows the date of purchase, the purchase price for each property, again, the number of units of each property, location. But I really want to point out the sum at the bottom of the purchase price column, and then also the sale price. You'll see the total purchase price was about $50 million for these assets. And our total sale price for all of those assets, it's about 25 properties, I think 24 to be exact. And you'll see the gain of about $23 million, so a 46% increase in property value. Now again, keep in mind that's just the value added on an unlevered basis. So that's if we bought the properties $50 million in cash, that was the approximate gain. Now, of course, that doesn't include any CapEx that we spent, any positive or negative cash flow on a monthly basis, nor does it include the leverage. So it doesn't show the cash invested in each property, because obviously when we buy, we have a cash and mortgage. So the 46% is just showing the value increase in the properties from a purchase to a sale. So again, in a quick summary, what do? We buy the assets, but what we do is we're very active managers. We're looking to optimize and we're looking to add value. We add value obviously through renovations, through improvements in management efficiencies, reductions in expenses, and just repositioning assets in the markets. We try and target Class C properties in Class B neighborhoods, so we can bring the property value up to the surrounding neighborhood. So again, it's a way that we can add value and ultimately increase the asset values. We're going to run through a few case studies. So these are actual buildings that we've bought and sold or bought and currently hold. This is a property that we bought in Texas in fall of 2007. Here's some of the before pictures on the exterior. You see some of the deferred maintenance, fascia on the balconies falling off, parking lot issues with the asphalt, just a lot of a tired-looking asset, an asset that needs some work. Here's the after pictures. This is after about 18 months of ownership, and we invested about $1 million in CapEx in that time. Quite a difference. This is another building that we no longer own, but this is a property we bought in Red Deer. Here's the before, and here's the after. So this is new siding, new balconies, some work in the parking lot. And then also what's not shown here is the work on the inside. So here's another building that we actually currently own in our Kings Castle investment fund, which is currently open for investment. So this is a kitchen before, and this would be the kitchen after. So again, we're not looking for high-end, stainless steel appliances, granite countertops, hardwood floors. We're looking to create the most value for the least amount of cost. So we're looking to really get the biggest bang for the buck. And it includes things like painting cabinets, changing hardware on the kitchen cabinets. It's new flooring, new lino flooring, new vinyl new countertops, new appliances. But again, getting the biggest bang for the buck is key, because we're looking to spend maybe $4,000 to $8,000 on a upgrade, and if we can increase the rent $100 to $200, we'll get $10,000 to $20,000 lift on the unit value, and we're looking to essentially double that capital investment, so doubling the value of that cash invested in the units. So what do we do? Again, in a nutshell, we buy, we fix, we add value to the properties. And so typically what we're doing is when we go in, when we acquire an asset, we'll sometimes buy the asset with a 1-year mortgage, which gives us time to go in to add value and to increase the value of the asset within 12 months. And then typically what we'll do is we'll refinance the asset, pull out some of the equity, and use that equity or use that cash that we've extracted from the properties into buying more assets. So it's something that we've done many, many times before, and we'll continue to do as well. This is a snapshot of Kings Castle LP. Now, Kings Castle is our current investment fund open for investment today. It's a $15 million fund. We've raised about $11 million of the 15, so there's about $4 million cash left available. We own 6 assets. The top 4 are the apartment buildings that we own in the fund, the 120 units in Calgary, which I'll get into more detail on each of these properties in the next few slides, but this is kind of the overview, gives you an idea of geographic location, property sizes, etc. We own in the 120 units in Edmonton. Kings Castle owns a 25% interest in the property. Our previous partnership, Prism A, owns the other 75% ownership in the property. So it's just the timing of when we closed the previous fund and opened this fund. The second building is 18 units in Red Deer, 100% ownership. We bought this one in November of 2012. Next one, 71 units in Edmonton. We bought in fall of 2013. And then 18 units in Red Deer, about a block away from our other building in Red Deer. So again, create some management efficiencies. The 2 properties on the bottom are kind of our special opportunity portion of the fund. Kings Castle made $1 million cash investment into 290 acres of development land in Cold Lake, Alberta, Cold Lake being an oil sands area. We own 50% of the property with Prism, who owns the other 50% of the property. We're currently working with our conditional subdivision approval for phase 1, which is about 30 acres of the 300 acres. And we're planning to build 32, we're subdividing 32 lots on the first phase. And we're currently selling lots to investors as well. So Thomas will touch on that a little bit later in the presentation. The last property, which we just acquired in December, is a 32-pad mobile home park in Black Falls, Alberta. Black Falls being kind of a bedroom community of red deer in central Alberta. It's on about 5 acres of land right on Highway 2A, across the highway from all the new highway commercial. There's a new A&W, Tim Hortons, Microtel Inn. Everything is just on the east side of the highway from our property. So it's a tremendous redevelopment site, and I'll show you some numbers here in a minute. So this kind of gives an overview of the performance to date within the fund. Shows the 6 properties, shows our purchase price for each property, and then shows the estimated values as of first quarter 2015. So we're just getting appraisals done for our IFRS financials, and you can see there's some tremendous lift in the values of those assets already. So again, great opportunity in our opinion. A little bit more detail. So this is a 120-unit building in Northeast Calgary. The property is called Castleview Park, and it's on Castle Ridge Drive in the Northeast, just east of the airport. It's a property we bought in late 2010 for $14.65 million. So it was about $120,000 per unit. The opportunity with this property was to go in and improve the management efficiencies. A lot of the exterior improvements had already been done to the property. You'll see new siding, you see new rock feature walls on the exterior. The only major capex that we've done is roof replacements. You see the shingled roofs. And then we've also started a balcony replacement program. A lot of the work had already been done to this asset though, so it's really about improving the efficiencies. When we bought this property, the monthly rent roll was about $104,000 per month. And today we're about $138,000 per month. So a significant increase in about 4 years of ownership. You'll see the NOI from 2011, 2012, 13, 14 gradually increasing, which increases our cap rate, which is essentially the unleveraged yield on the asset. If we were to buy the asset all cash, how much cash flow after all of your income and expenses is the property generating? So you can see a nice gradual increase there as well. As mentioned, we're just in the process of getting our appraisals done, and I anticipate by Friday this week we'll get our new appraisal. I expect it to come in at around $22 million. We just got our tax assessment a few weeks ago, and it showed a value of $21.9 million, which I think is fairly accurate to where the value is today. So again, some pretty good increase in value since ownership. Again, keep in mind these numbers are for the full building, but Kings Castle only owns 25% of this asset. The second property, or the second apartment building that we bought in the fund, was this 18-unit building in Red Deer. It's called Hawkwood Manor. We bought in November of 2012 for $1.75 million. So 18 units, it was less than 100,000 units, so about $97,000 per unit. All 2-bedroom units, and it was already condo converted. So selling as condos is not our primary business model, but it is an exit option that we could pursue in the future if there's the opportunity or if there's the market for it. Similar, you see the NOI increase, you see the cap rate increase. About a year ago, so February of 2014, we refinanced the asset, and we refinanced the original $1.2 million mortgage with a new $1.7 million mortgage. So we pulled out about $500,000 in equity to buy additional assets in the fund. So, and again, we see the value. The appraisal in the next day or two will probably come in around 2.3, maybe a hair over $2.3 million. Our third building that we bought was in fall of 2013. It's a 71-unit building in the north side of Edmonton called Castle Harbor. This building has a very, very good suite mix. So when we say suite mix, a lot of the units are 2-bedroom units, and specifically in this property, they're very, very large two-bedroom units for existing rentals. They're almost 1,000 square feet. So our purchase price was $10.65 million. So on a price per door, the price sounds on the higher side of the price per unit that Thomas was showing in Edmonton. But if you take a look on a price per square foot, our purchase price was around $160 a square foot. So significantly below replacement costs if we were to rebuild this property today. So you can see the NOI was quite low when we bought it, and the cap rate, sorry, was quite low, but it was because the property was owned by the original owners. They kept the rents extremely low, and we had an opportunity to go in there and bring rents up to market, even slightly below market. And we saw very little turnover. We raised rents to about $11.50 for the 2 bedrooms earlier last year. We saw virtually no tenant turnover because they knew that it was still tremendous value and they liked the property. So we saw a huge increase in revenue, and we just refinanced the property in Q4 of last year, and we put a new 5-year mortgage that we locked in at 3.15% interest. So there's some pretty good interest rates right now. The next property that I'm going to talk to you about is the 18 units in Red Deer. We've just actually refinanced this property as well. We're in the process of refinancing it, and we have a term sheet with a lender for 5 years at 3% interest. So very, very good interest rates. This is very similar to our other Red Deer building, 18 units just down the street, just over $100,000 per unit on our purchase price. The original mortgage we currently have is about $1.6 million. So you see our down payment was $290,000. And we're going to refinance with a $1.7 million mortgage, pull out some equity, and do it all over again, likely use that money to buy another property. Again, I expect the value to come in around $2.3 million for this property, mostly 2-bedroom units. This is a great long-term hold, close to downtown Red Deer. We're quite excited about this one as well. This is our most recent acquisition. This was in early December of last year. We took possession. It's a 32-pad mobile home park right on Highway 2A, just north of Red Deer in the community of Black Falls. Again, as I mentioned earlier, it's right across the highway from all the new highway commercial. It's the first property you see as you come south into town. And it's an existing park. It's been there for about 45, 50 years. But what really intrigued us about this property is the future redevelopment opportunity with the site. It's about 5 acres, and the appraisal that we had on the property was, assuming we rezoned it for highway commercial, which is the highest and best use, the appraisal came in around $2 million, which was, about $450,000 higher than our purchase price of $1.5 million. So if we're able to get the rezoning, the community or the town really would like to see the site redeveloped through time or in the future, there's some great value add through that site development. In the meantime, though, it also provides a steady income stream for us until we wait, or until we plan to develop it. And this could be 2 years from now, it could be 5 years from now. I mean, we're just looking at different options at this point in time. But the existing pad rent for each unit was about $400 per unit. And we've already given rent increases for June 1st of this year to $475, which is still quite low for the market because that we're paying utilities, so there's water and sewer that's included in that rent, which is not typical for parks in Alberta. So usually you see similar rents, but tenants usually pay their own utilities as well. So we're looking at options. We could also, if we're going to delay the redevelopment of the site, we could look at submetering the water for each property to decrease our expenses and ultimately increase our NOI. So there's many options for this site. When I say the pad rent too, we're just landowners. Each homeowner owns their own house, and the great thing about that, as the owner of the park, is that we collect rent for the pad, and we're not responsible for the repairs and maintenance of each individual unit. So replacing carpet or kitchen cabinets or anything is the responsibility of each of the owners of the homes. And another great thing is you get very little turnover of homes. It's very expensive. It's about $6,000 to $8,000 to move each home, and so you see very little turnover throughout the years. And I think this park's been full for the last 12 or 13 years. So I think we'll see some pretty steady income from this property. with that, I'm going to bring Thomas back on. He's going to talk a little bit about Cold Lake. It's our current land development project, which we're currently working through our detailed engineering on and currently marketing our phase 1 lot sales. And then he'll also talk a little bit about the details of Kings Castle and how you can get involved in these properties, as well as this Cold Lake property. Thomas?
Thank you, Mike. So what you heard now from Mike is specific assets, and Mike has a very important role in his firm, namely to scout for assets, because for every building we buy, there's probably 10 we look at in great depth and write offers on perhaps 5 of them. But before we look at 10 in depth, there's probably 50 which come across his desk. There's a lot of filtering going on before you actually even look at buildings and write offers on. So it's a great very important role to have in this firm, and we've seen the result of some tremendous lifts here in most of these buildings. We have decided, both in Prism A, which is our previous fund, as well as Kings Castle, that we will take a portion of the money and invest it in what we call special opportunities, because every so often we come across deals where we say, well, this is such a fantastic deal, but it's not really an apartment building, it's not a mobile home park, it's not a rental property. And we came across this lands project here about 4 years ago, and have invested now another few $100,000 to bring the servicing forward, and we envision going into the ground in the second quarter and developing these 32 lots. If that is of interest to you, we have an interesting investment opportunity, which I put on our Facebook page, where you invest essentially about $70,000 cash and can get $100,000 back. So you make 30 on 70. If that interests you, then please go to our website, and there's some links. And we will do another webinar next week on that topic by itself. The appraised value, as if serviced for these 32 parcels, is already $7.7 million, plus the remaining land has currently a value in its undeveloped state of at least $5 million. And if you now develop these phases, phase by phase, there's huge upside potential for this roughly 10% of the money in Kings Castle invested in this project. So we want to keep Kings Castle sort of in that 10% range. We don't want to put more money in, because the design point of the LP is specifically for rental properties. But if the land project interests you, then go to our website. There's some links, and there's more information on a related website called The Heights at English Bay. Very exciting project, but certainly beyond the scope of this presentation tonight, and certainly not a rental property. And also higher risk, I would say, but also a higher return potential. So how can you get involved in Kings Castle? You can buy units. The units are priced at $5,000 and have been at that price for the last 3 years. People get a 6% drip option, though, usually. And now people who invested perhaps 3 years ago made already 18% versus you coming in today. The target ROI is in the sort of 8 to 10% range per year. We aiming to get you 50% return in 5 to 7 years. That obviously is depending a bit on the performance of Alberta, but we think we can deliver that. I showed you earlier some charts with a mortgage pay down, how we, even in flat markets, can make money. The LP will close later this year. We raised about $11.5 million out of the 15, so we'll envision that we're going to close it later this year. You buy these units in $5,000 increments, and then you have 2 options. Either you take a 5% cash distribution annually, paid quarterly, which is what perhaps 10% of our investors do. Most investors take the growth option, where they get 6% more units every year. But you can also switch maybe after 2 years if you decide, look, I'd rather take the cash flow, then you can do that. It's not specifically designed as a REIT, because REITs tend to have much lower leverage because they pay out most of the cash flow to investors. So it's not specifically designed as a yield product. That might be something we might do next year. And it can be invested from an RSP or from a TFSA or a LIRA, or certainly in cash as well. The idea is that you exit after 5 years at a minimum. Prism A now has been in existence for over 7 years. We have seen about 10% of people leave. Out of 300 investors, we had about 30 leave after 7 years. So it's really up to you. There's a penalty, declining penalty, which goes from 25% down to 5% if you leave early. So we suggest that you stay in at least 7 years, because as I showed you earlier, the costs of the LP and the buildings drop off dramatically after year 3 or 4. There's just a lot of marketing involved and fundraising costs and building startup costs, which have to be absorbed by the investors in the end who co-own all these buildings. So the longer you hold, the better returns usually are after, sort of years 6 and 7. There's 3 general partners, myself, and then Mike, you heard, and then Scotty. We take no salaries. We take a smallish 0.5% management fee. We qualify for all the mortgages, sign personal guarantees on the mortgages. We have invested a substantial amount of money in this LP, and we profit only after you profit. So once you get your money back, then of course we want to make money too. We take a 40% share of the profit, but only once you get your money back. So we have to hustle to get your money back, and then we make money. So if we for some reason screw up and you just get your money back and make no money, even we make nothing. So we don't really want to do that. And to summarize really why we think we have a great product here, it's a tax efficient structure, because the gains on the buildings are both tax deferred and also tax preferred, because once we sell the building, perhaps in 6 or 7 or 8 years, we pay only capital gains taxes. And until then, there's usually no taxes payable, even on cash flowing assets. It's primarily based on income producing assets, which are very stable and have relatively predictable equity growth through the mortgage pay down and rental increases, even in flattish markets like Alberta right now. It's a diversified pool of properties, so you don't buy just one building, but in this case, as Mike showed you, there are 6 of them. We specifically enhance the value of these assets through a value add strategy. So even if the market might be flat in Alberta, doesn't mean that that building doesn't go up in value, because we might still improve the asset and the rent might still go up 20% in 3 or 4 years through improvements, even if the overall market perhaps is flat. Certainly provides you with a diversification from the stock market, because we're completely disconnected from the stock market, and you can now buy these buildings essentially with your RSP if you want. We sell these limited partnership units and RSP units through exempt market dealers, because both Mike and myself are not licensed dealers. We use exempt market dealers, or private equity dealers, when you want to call them. We have currently 5 of them: TriView, Sloan, Ascendo, Royal, and Pangea. There is about 100 people within these 5 firms who can consult with you. There's usually several per city. If you're not working with one at the moment, please contact our office, and we'll hook you up with one of these investing advisors who will ask you some questions about your current investments and how much money you want to invest, and do a risk assessment and what's called a know your client form, because we don't want to take your 100,000 if it's the last 100,000 you have. They ensure some diversification across your own portfolio. And there's a website, and there's a lot of questions answered on our website, and videos and testimonials, and more details on the buildings and track record and blogs. So you can go there and send us questions. That really concludes the hour tonight. I appreciate your time. We do have time for questions, and maybe I'll pass it to Mike to tell you how to do that, either online here via the panel on the right on your screen, or we can do it live, but I'm going to give that back to Mike.
Yeah, thanks, Thomas. As mentioned, if you take a look at your control panel, there's a section in there where you can type in questions. We've got a few questions right now, so we'll go through those. But if anything comes up while we're answering these, or if you have further questions, please feel free to type them in. Of course, if something comes to your mind after the fact, please do email us at investor@pressprop.com, and we can answer any other questions, or you can see us at our website, pressprop.com. So first question, Thomas, is with regards to Cold Lake. The question is, would you consider this a high-risk investment as it's being sold to owner-occupiers? But as oil prices are dropping, no one is buying. Please clarify your views and ideas.
The risk comes from being overly levered. The risk doesn't come necessarily from market demand. Obviously, higher demand is better. The risk, in my opinion, comes from excessive mortgaging of assets, especially with no income. So at the moment, we have no interest-bearing mortgages on this land. We have a payable to the previous owner, which we will do in June. And the strategy right now is to pre-sell lots to investors. As I mentioned briefly, you can buy a lot at a substantial discount. We then give you a buyback option. And if you put a line of credit on that, if you want, you can turn about 70,000 into 100,000. If that interests you, then please let us know. That's how we want to reduce the risk. So we want to treat this essentially as a cash-only investment, and therefore we can be patient sellers. We don't want to have 10 houses for sale, and then we sell 2, and then we have mortgages on 8 more, and mortgages on the land, and that creates the risk, and that's why many land projects have failed. Not necessarily because of the demand. Because the demand will pick up. We have one of the very few, if not the only spot in town where it's actually dry land. We're sitting up on a hill overlooking the lake. All the lots we showed you earlier have lake view, and they're large lots, half an acre. And the price point we're targeting is about in the high 400s, house plus lot, which is just slightly above a tiny little house in Cold Lake. And we envision that we have people moving there, even who currently have a house, not necessarily people who move from from other towns into Cold Lake. So I think the risk can be mitigated through a sound marketing strategy and not overbuilding and not having a mortgage.
Thanks, Thomas. Next question is regarding acquisitions. How do you find these properties to buy? Through a realtor, through referrals, or other means? I can take that one. I mean, typically, because we've been in the market for about 15 years, there's a lot of owners and a lot of commercial real estate agents that know we're in the market and know that we're serious. So often they'll call us directly, and specifically owners. There's a number of the properties in Kings Castle that we bought directly from an owner who knew about us and knew that we were in the market and had called us and indicated that they had the property for sale, which is a great opportunity because it created no competition with other buyers to acquire the property. We also, again, as mentioned, we have good relationships with a lot of the commercial real estate agents across Western Canada, and often a lot of the larger properties are sold off market, and they're one-to-one sales and direct sales that way. So often they don't even hit the market. So we have access to a lot of deals that you wouldn't be able to find on ICX or MLS or anything by those means. So it's really a relationship, and based on our track record, that people call us and email us with their opportunities. Thomas, would you like to add anything?
No, it's good. I mean, again, because we've been buying for years, and we tend to close on buildings which we write offers on unless we find some major undisclosed deficiencies, which occasionally happens, right? Some people are known for squeezing people at the end, and they're always known for, taking off $100,000 at the very end, even if the building is pristine. We're not known for that. So we often get first dibs on certain buildings than others where they're known for squeezing at the end, right? We do squeeze if necessary, if there's deficiencies, And then now, as I mentioned earlier, I mean, we're going to see a bit more motivation, or a bit more realism, let's call it, on the price, because we had often in 2014 it was tough to buy because prices were just so out to lunch in terms of rental expectations and cap rates, So we are going to see a bit more realism now. But as I mentioned earlier, the rental rates, I don't expect them to drop. And while you might see softening in the single-family house market, and certainly in the new construction market, there will be a lot of discounts on the new construction side. I think we don't see that on the rental side.
Thanks, Thomas. Next question is with regards to Kings Castle, and the question is who is eligible to purchase LP units?
Well, that depends a bit. Depends on the province. In BC, I think most people are eligible. If you invest $10,000 or less, every person is eligible. In Ontario, you have to be accredited or invest over $150,000. In most other provinces, you have to be what's called an eligible investor, which means you have to have an income of over $70,000 or net worth over $400,000. But again, these exempt market dealers will walk you through the requirements, and then they will tell you whether you're not eligible or not, or whether you're eligible. That's part of their job, to assess the financial viability. And that rule was introduced about 4 years ago because we have seen many syndicators collapse in 07, 08, 09. Some with shady deals, some with excessive fees, and some just because the market turned down. So the exempt market dealers have their own due diligence before they take on a company like us onto their shelf. So we're happy to be on 5 shelves right now. There's a lot of people in the market who like to sell our product. But they will do an individual assessment for your specific situation.
Thanks, Thomas. Moving on, the next question is a good one. It's about the webinar and a recording. So the question is, how can we listen to this webinar again or share it with friends or family?
Or should you?
Well, we are recording it, as mentioned, and probably within the next week or so, I'm guessing by early next week, we'll have a link on our website, and we'll have a recorded copy of the webinar, this exact webinar that you can listen to and share as well. So it will be on the website. There'll be a link right on the homepage, which will direct you to the webinar.
Yeah, we have one online right now from last fall, which is, has similar charts, but the numbers are a bit older, and there's some new stuff on Alberta. And lots of stuff on our website. There's a lot of content on our website, so please feel free to go there and click around, and lots of articles and blogs, and frequently asked questions, and a lot more detail on some of the buildings.
So next question is about Kings Castle, and the question is are there any other acquisitions expected within Kings Castle? Thomas mentioned that we are currently in the process of writing an offer on another apartment building in South Edmonton as we speak. I'll probably have the offer submitted tomorrow, so we'll know within the next week or so whether it'll be accepted or countered. We have also, late last week, we wrote another offer on another mobile home community in the greater Edmonton area. And that offer is currently open for the owner to accept within, I believe, by this weekend. So we do have a few other properties that we are currently looking at. Of course, as Thomas mentioned earlier as well, we are quite active. We write offers, and if we're not successful with those ones, we will. There's other properties in the pipeline that we've identified that could be good acquisition candidates. So. We see lots of deal flow, and there's always opportunities coming across our plate. So, it's just doing it wisely and making sure that that we buy the right assets for the right price. Final question that we have at this point is: are you expecting to pre-sell the lots and houses throughout 2015 for Cold Lake, and thus sell out in the current market conditions?
That's a good question. We expect to sell quite a few lots to investors because that's really a financing tool to us. We will then build 3 or 4 houses in Cold Lake and start marketing heavily probably later in the second quarter into the third quarter. And then we will see what the demand is really in earnest. And, of course I'd like to sell 30 houses a year, but if you sell only 5, well, then we'll sell 5. The trick is to not be overly levered and not spend too much money up front, expecting unrealistic absorption numbers. Currently, there's about 400 houses a year trade in Cold Lake, both existing ones and new ones. Historically, there were about 100 houses brand new per year. I expect that number to drop substantially next year, or in 2015, 2016. But as I mentioned, we'll do a webinar just on that next week with some more details. And even in the recession in 08, 09, there were still 100 houses constructed and sold subsequently in Cold Lake. So I don't think the market is falling off the cliff. There is, an Air Force base with several thousand employees. Not the oil sands projects, which are there today, are fairly labor intensive. So there is people there today who need houses, and it's not that Cold Lake will disappear from the map of the earth. So we expect a steady absorption, yes, not nearly certainly as high as maybe a year ago, certainly.
And one more question came in here, Thomas, again with regards to Cold Lake, and more so on purchasing a lot. And I guess I'll start with saying that we are planning another webinar later next week with more information and more details towards purchasing the lots in Cold Lake. So I would hope that the questions would be answered at that point. But at this point, Thomas, can you answer this question? It's with regards to, again, if you purchase a lot in Cold Lake, can you explain how the investment could potentially turn $70,000 into $100,000, and then where we can find that info on the website?
On the website is some links to the Cold Lake website, which is called heights@englishbay.ca. You type that in. But there's links from our main PressProp website to that as well. Essentially, let's say the appraised lot is $220,000. You buy the lot for 10% discount, which is $198,000. You get a 50% line of credit. Let's say at 50%, 3% interest rate from your bank on that. So you need to pay $99,000 in cash to buy this lot. We then, on closing, once we have the servicing complete, which is let's say June, we will pay you roughly $29,000 as a buyback option, so we can buy the lot back within 18 to 24 months to build houses on for that $198,000 price. So you basically now come up with $99,000, but we're going to rebate you or pay you with the lot, the option to buy for $29,000. So really, you're out of pocket only $70,000. Now you take title to the lot, and then within 18 months, we will buy back the lot, and you make $30,000 on 70. That's almost a 40% return. So that's basically the simple sales pitch. Worst case, I think, is now you own a lot in Cold Lake where you paid $160,000 or $1,000 for, and it's appraised for $220,000, right? Because we have the option to buy, not the obligation. So it's a financing tool to us to create cash so we can service the land as well as build houses. And we don't need to sell all 32 of them. If you take even 10 or 15 of them, that's good enough for us. So it's a financing tool for us and a great investment opportunity, short term. Because Kings Castle clearly is a more long-term strategy which cannot deliver these kind of 30-40% returns in a year or two. It's just not possible, but you can get 30-40% in 5 or 6 years, right? And
yeah, I think, Thomas, I'd like to add too. I mean, as we talk about these projected returns, nothing is guaranteed, and as Thomas mentioned, it is an option to purchase the lot back. So that the worst case is that we feel that you would own the lot, but again, the upside potential is what we think is reasonable to anticipate or expect. It definitely is not guaranteed, and that goes with any of the investment opportunities that we have.
Two things are guaranteed in life, right? Death and taxes. Everything else is has some risk attached to it. Any more questions, Mike, or that's it?
Yeah, one more came in with regards to Kings Castle. The question is, could you please clarify the 0.5% asset management fee and how investors are paid out before PressProp is, and what percent PressProp shares in when the deal is profitable?
The 0.5% is measured on the asset value. So if the asset value is $10 million, it's $50,000. In the Red Deer deal, for example, the asset value is $2 million. It's a $10,000 fee per year. So it's quite small. We take 40% of the upside once you have your money back, because there's initial startup costs. It takes a while to generate a return. That's why there's these penalties to get out early. We like to make money for ourselves, obviously. The fund doesn't exist primarily for your benefit. It also, of course, exists for our benefit. So it's about win-win, right? So you make money when we make money, and vice versa. So the belief is that the fee should be low, really low, and there's no upfront lifts or no upfront costs stuck into our own pockets, but there's really no incentive to work anymore. The incentive really is to work hard and get the values up, so that we make money at the end. That's when you make money. So the idea is to align our profits with yours, as opposed to some other funds where they make money regardless of whether you make money or not. So
thanks, Thomas. And it looks like that's all the questions. Do you have any final words before we wrap up?
Well, real estate is a proven wealth generator if you hold it long enough. So don't wait to invest in real estate. Invest in real estate and wait. And what we offer is essentially a vehicle for you to become a landlord without the hassles. And I want to invite you to join us, as 7 other investors have done, and you will enjoy the ride. So thank you for phoning in tonight, and hopefully it was insightful. And if there's any other questions, again, send us an email. I'll take phone calls too, directly one-on-one. So love to hear from you personally at some point, or see you at some events, perhaps webinars and seminars we do every so often. Again, thank you for phoning and listening, and have a good night, guys.
Thank you.